Gold hit $5,310 an ounce in January of this year, an all time high. The gold bulls were everywhere. The headlines were euphoric. Everyone who had been skeptical for years was suddenly asking whether they had missed it. Then the Iran war pushed oil above $112 a barrel. Inflation spiked. The Fed signaled rate hikes and gold fell hard, 27% from its January peak, down to around $4,000 as I record this. And now the same people who said gold was too expensive at 3,000 are saying it is broken at 4,000. Peter Schiff published something this week that stopped me cold, a historical comparison so specific and so precise that it does not feel like a prediction. It feels like a spoiler. He has seen this movie before. He knows how it ends. And he says the number at the end of it is $11,100 per ounce. Today, Peter Schiff tells you exactly why. Let's get into the video.
I want to show you something. Not an opinion, not a forecast, not a prediction based on how I feel about markets or what I think central banks are going to do or what my macroeconomic model suggests about the future of the dollar. A number, specific, historical, verified. The kind of number that does not require you to trust me or agree with my politics or share my views about the Federal Reserve or believe anything I have ever said before this moment. Just a number and what it implies. In the early months of the 2008 financial crisis, in the specific window between March and October of 2008, gold fell 32% from its prior peak. 32%. During what would eventually become the greatest gold bull market of the modern era. During the run that would take gold from roughly $800 an ounce all the way to $1,900. The metal that everyone eventually agrees was the single most important asset to own through the 2008 crisis fell 32% right at the beginning of it. And everyone called it finished. The same headlines you are reading today about gold, the same dismissals, the same confident declarations from the people who had been skeptical all along that this was proof they were right. Gold is not a real investment. Gold does not work. Gold has failed as an inflation hedge. The gold bull market is over. They were wrong, completely and expensively wrong. Gold did not just recover from that 32% drawdown, it surged 178% over the following 3 years. 178%. Anyone who sold gold during that 2008 drawdown because the headlines told them it was finished gave away one of the greatest wealth-building opportunities of the last 50 years. Now, here is the number I published this week that I want you to sit with. Gold hit $5,310 per ounce in January of this year. It has since fallen 27% to approximately $4,000 at its recent low. 27%, almost exactly 40% of its prior bull market gain from $2,000, which is almost exactly the same percentage drawdown and almost exactly the same proportion of the prior bull market gain that gold experienced in 2008, right before it surged 178%. The numbers line up with a precision that made me look at them twice when I did the calculation. A 178% surge from gold's recent low of $4,000 puts the price at $11,100 per ounce. $11,100. Now, before the people who have been wrong about gold for 20 years start composing their responses about why this comparison is invalid and the situation is different, and Schiff has been wrong before, let me tell you why I think it is not just valid, but almost uncomfortably precise. And then let me tell you why the situation right now is actually more favorable for gold than 2008 was. Not less, more. Why the 2008 comparison is not just a coincidence. The 2008 gold drawdown was not random. It was not a sign that the gold bull market was over. It had a specific and understandable cause. And understanding that cause is what allows you to see that the current pullback has almost exactly the same cause, which means it is likely to have almost exactly the same resolution. In 2008, when the financial crisis began to accelerate, something happened that surprised a lot of gold investors. The dollar went up, not because the dollar had suddenly become strong, because global investors were selling everything, stocks, commodities, emerging markets, and running to the one asset that was still universally accepted as the settlement currency of last resort, the dollar. This is what I call the dollar's emergency reserve function. In a moment of acute global panic, when trust in every other asset is collapsing simultaneously, people run to dollars, not because they trust the dollar's long-term value, because they trust that everyone else will accept dollars in the immediate crisis, even if the long-term value of the dollar is questionable. That flight to dollars in 2008 drove the dollar index higher, and a stronger dollar mechanically pushes gold prices lower because gold is priced in dollars. The stronger the dollar, the fewer dollars it takes to buy an ounce of gold, so the dollar price of gold goes down, even if the real value of gold in purchasing power terms has not changed at all. This is exactly what happened in the first half of 2008. The crisis accelerated, the dollar surged, gold fell 32%, and everyone declared the gold bull market dead. Then the Federal Reserve started printing money. Then quantitative easing arrived. Then the balance sheet expansion began, and gold, which had not actually become less valuable during the drawdown, but had simply been mechanically pushed lower by the temporary dollar surge, exploded higher as the real story of what the crisis meant for the dollar's long-term purchasing power became undeniable. 178% in 3 years. Now look at what has happened in 2026. The Iran war pushed oil above $112. Inflation spiked. The Federal Reserve, which had been expected to cut rates this year, is now being forced to signal rate hikes instead. Higher rates make Treasury bonds more attractive relative to gold, which pays no interest. International investors who were holding gold sold it to buy yielding dollar assets. The dollar index strengthened. Gold fell 27%, and everyone is declaring the gold bull market dead. I have seen this movie. I know the script. The ending is not what the people declaring it dead think it is. Why 2026 is actually more favorable for gold than 2008 was. Here is the part that should concern the gold skeptics most, because they are not just wrong about the comparison. They are wrong in the direction that matters most. The conditions that caused gold to surge 178% after the 2008 drawdown were significant. A Federal Reserve that cut rates to zero, quantitative easing on an unprecedented scale, a national debt that was already uncomfortably large by historical standards. The conditions today are more extreme in every single dimension. The national debt in 2008 was approximately $10 trillion. Today, it has crossed $39 trillion. The interest payment on that debt alone is now projected to hit $1 trillion in fiscal year 2026, more than the entire defense budget. The Federal Reserve's balance sheet, which was under $1 trillion before 2008, is now over $7 trillion even after years of attempting to reduce it. The dollar in 2008 was weakening, but still held its reserve currency status with reasonable credibility. Today, the dollar's share of global foreign exchange reserves has fallen to below 57%. Central banks around the world are buying gold at rates not seen in decades, specifically because they are reducing their dollar exposure. The de-dollarization that was a theoretical future concern in 2008 is a measurable present reality in 2026. The Iran war, which the gold bears are treating as a reason to sell gold because it creates short-term rate pressure, is actually a symptom of exactly the geopolitical fragmentation that drives de-dollarization and gold accumulation over the medium and long term. Every country watching America's military limitations exposed in the Strait of Hormuz is drawing a conclusion about the reliability of dollar-denominated reserves, and the conclusion they are drawing, the one being expressed through central bank gold purchases that continue to accelerate regardless of the short-term price, is that gold is a more reliable long-term reserve than the dollar. So let me summarize what I am actually saying. The 2026 gold drawdown looks almost identical in magnitude and cause to the 2008 gold drawdown. The 2008 gold drawdown preceded a 178% surge. The fundamental forces driving gold higher in 2026, the debt dynamics, the de-dollarization, the monetary expansion that the Federal Reserve will eventually be forced into, regardless of what it is signaling today, are more extreme in 2026 than they were in 2008, and $11,400 per ounce. The price that a 178% surge from the recent low implies is not a fantasy number. It is a conservative extrapolation from the most directly comparable historical precedent available. The rate hike narrative, and why it is the same trap that fooled people in 2008. I want to address the specific argument being made right now by the people saying gold is finished, because it is coherent on the surface, and it fooled a lot of people in 2008 for the same reason. The argument is this: the Federal Reserve is signaling rate hikes. Higher interest rates make Treasury bonds attractive. Bonds pay a yield that gold cannot match. Therefore, investors will sell gold and buy bonds. Therefore, gold goes down. This argument is correct in the short term, exactly as correct as it was in 2008 when the flight to dollars and the initial rate dynamics pushed gold down 32%. What it misses is what always happens next. The Federal Reserve cannot raise rates high enough to genuinely control inflation without triggering a debt crisis that is more severe than the inflation it is trying to control. Here is the arithmetic that the rate hike narrative refuses to engage with directly. The United States government has $39 trillion in debt. Every 1% increase in the average interest rate on that debt adds approximately $390 billion to the annual interest burden. The current projected interest cost is already above $1 trillion annually. If the Fed raises rates aggressively enough to genuinely suppress the inflation being driven by oil above $112 a barrel, the interest burden on the national debt becomes genuinely catastrophic. The government cannot afford the cure. That is the trap. That is the impossible choice that every central bank eventually faces at this stage of the debt cycle. And the resolution of that impossible choice, the thing that always happens when a central bank faces the choice between fighting inflation and managing the debt burden, is that they manage the debt burden. They print, they expand the balance sheet. They find reasons to justify monetary accommodation that allow them to avoid the fiscal crisis that genuine monetary tightening would trigger. They did it in 2008. They did it in 2020. They have done it every single time the choice has presented itself in modern monetary history. And when they do it in 2026, when the inflation that is already running hot meets the monetary expansion that the debt dynamics will eventually force, gold is not going to stay at $4,300. The dollar's worst year in a decade and what comes after. Let me give you one more piece of the picture because I think it is being systematically underreported in the financial media right now. The US dollar had its worst year in nearly a decade. In 2025, it fell against the Swiss franc by 13%, against the euro by 12%, against the renminbi by 4%, against gold by 39%. 39%. That is not a minor fluctuation. That is a structural signal of the kind that precedes significant and sustained currency weakness, and the causes of that weakness have not gone away. They have intensified. The debt has grown. The interest burden has grown. The geopolitical developments that are driving de-dollarization have accelerated. The Iran conflict has exposed the limits of American power projection in ways that reinforce the conclusion that dollar-denominated reserves carry a political risk that alternative reserves do not. The dollar is not going to recover to its prior strength, not because I say so, because the mathematics of $39 trillion in debt and $1 trillion in annual interest payments and $2 trillion in annual deficit spending do not support the kind of fiscal credibility that a strong reserve currency requires. When the dollar weakens, gold goes up. This is not a complicated relationship. It is arithmetic. And the arithmetic is pointing in one direction with a clarity that I have not seen in my career, matched by this many reinforcing factors simultaneously. I said gold was going to 5,000. Gold went to 5,300. Now gold has pulled back 27%, and everyone is asking if it is over. I am not asking that question. I am asking the question that matters. If the 2008 comparison holds, if the fundamental forces driving this gold bull market are at least as powerful as the ones that drove gold 178% higher after the 2008 drawdown, and I have just shown you why they are more powerful, where does $11,100 per ounce leave the people who sold during the pullback, and where does it leave the people who recognize the pullback for exactly what it is, the same temporary setback driven by the same temporary cause that appeared in 2008, right before one of the greatest gold rallies in history, and bought more? I am in the second group. I have been in the second group my entire career. And every single time the headlines have told me the gold story was over, every single time the bears have gotten loud and the sellers have gotten aggressive and the price has fallen far enough to make the skeptics feel vindicated, the story has not been over. It has been loading for the next chapter. This is the same story, the same movie. I have seen it before, and I know exactly how it ends. Do you?
Gold at 5,300 in January, down 27% to around 4,000 at the recent low. And Peter Schiff pointing at 2008 when gold fell 32% right before surging 178% and saying the numbers match almost exactly, $11,001 per ounce. That is where a 178% surge from the recent low takes you. Believe him or not. The historical comparison is real. The numbers are real. And the question he is asking is one you need to answer for yourself before the next chapter of this movie plays out. Your action this week. Look at the 2008 gold chart. Find the drawdown, find where it bottomed, and ask yourself honestly, if you had been watching gold fall 32% in 2008 and everyone was telling you the gold story was over, what would you have done? Because whatever your answer is, it tells you something important about what you should do right now. What do you think? Can gold go up 178% from its recent low of around $4,000? Let us know your thoughts in the comment section below. And as always, I will see you in the next video. Bye.